Hello, fellow Rebel Capitals. Hope you're well. I'm here once again with the one, the only Chris Irons from the QTR podcast. He's going to help me break down all of the insanity that's going on with the markets. The yield curve inverted again. I mean, I would say this is almost unprecedented. We're going to have to check out what's happening with the 10-year Treasury yield and the Fed funds rate. Then we've got Bitcoin just collapsing down to, last time I checked, 86, something like that. And it's taking MicroStrategy down with it, or maybe vice versa. And then, oh my gosh, consumer confidence plummets. The Conference Board survey came out today, and it's seeing its lowest level in quite some time, a level that they're calling, these are their words, not mine, they're calling recessionary. So let's start off, Chris, by going over the 10-year Treasury yield. First, Fed funds, I want to remind everyone, I had that up. It's at 4.33%. So, it's in a range between 4.25 and 4.5. But the actual Fed funds rate, they have it set right now, 4.33. And you guys know from watching the videos that the 10-year Treasury yield has been plummeting. Since it hit that peak, maybe 2 months ago at 4.8, it's just gone straight down. And more recently, in the last few days, it's really gone down by 10, 8 basis points per day. Today, last time I checked, it was down by 10 basis points. Let's see where it is. Yeah, so we're down at 4.29. And again, guys, the Fed funds rate is 4.33. So the curve between the front end, the overnight rate, and the 10-year Treasury yield is now officially inverted again. And, I can say that this cycle I don't know if it's going to play out any different, but so far, the noise that we're seeing in the cycle with these interest rates, the bull steepener, the bear steepener, et cetera, that is playing out in a unique way. So usually what happens is the curve inverts, and then the Fed starts dropping rates. We get a bull steepener, so the front end of the curve drops faster than the long end. And usually when the curve uninverts, then it really starts to steepen out because the Fed drops, and then that's normally when the stuff hits the fan. We saw that as an example during the GFC. But this time, the curve uninverted, that would have been probably back maybe 4 or 5 months ago. Then we got to a point where, let's just say there was a delta, or it steepened by 40 basis points or so. The 10 years about 40 basis points higher than Fed funds, maybe 40, 50. And now we're right back down to where it's inverted again. So usually what this means, guys, long into the curve, it doesn't really have anything to do with supply or anything like that. It's usually growth and inflation expectations. So this should tell you that growth and inflation expectations in the market is coming down, and coming down very, very quickly. Chris, what do you think, buddy?
Well, I'm just, I guess my question to you is, do you think that the 10-year yield coming down now is a function of the volatility in equity markets? And I saw that rate cut odds were on their way up today. I saw Zero Hedge posted. And, do you think that now the pressure downward on yields is coming as a result of people expecting the Fed to cut? I guess is the first question. The second question is, if that's the case, and that Trump's going to kind of put this full court press on the Fed to cut, because once the shit really starts to hit the fan with the stock market, he's just going to go, guns blazing to try to remediate the problem in any way that he can, short of appointing himself Fed chair and lowering rates himself. But he will berate and insult Jerome Powell and bludgeon him, as will probably the administration, to try to get him to lower rates from that point forward. My question is, okay, A, do you think that's why the 10-year yield is moving lower? And B, what the hell would happen? So I've, bought some more gold miners today, right? Big surprise. Anybody that's been following me for years know that I've been buying gold miners forever, and they've pretty much stayed parked for the most part. They're up a little bit. But I bought some more today just under the guise of if they do cut, and that's what the 10-year yield is telling us, and really Trump's pretty easy to read in this regard. If they do cut, like what are gold and silver going to do if they start to catch wind of the fact that a cut is coming? And I think that this move in gold over the last 6 months really has been the precious metals market kind of getting wind of the idea that the Fed really doesn't have an answer. Normally this is the environment where you'd see gold continue to move lower because rates are staying, real rates are higher. And even though the Fed has cut logically as though they are targeting this 2%, this magic 2% number. So I guess my question is like, what the hell is going to happen to precious metals and any type of fixed assets the next go round if the Fed says, and like, what does that do to psychology too? It's going to be ugly, man.
Well, I think the question is, why are they cutting? So let's assume that they do cut more than the market is expecting right now. Why?
Well, they didn't cut the last go round.
I'm saying moving forward, if
right.
the market is pricing in 2 cuts, and let's say the Fed cuts 5 times in 2025, why would they be cutting? Most likely because the economy is going into a recession.
Right.
And in that type of recession, or in any type of recession, it's always disinflationary. It's never,
right.
You never have an inflationary recession doesn't exist. I know a lot of people like to point to the 1970s, and it is true that when we had recessions, prices were going up, but they were going up at a slower rate. So you had disinflation. Most people don't realize that with the 1970s. So as an example, 74, 75, you had, inflation go up, 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 but then you had the recession, you had the unemployment spike, which we always see. And then inflation comes back down. I'm not saying deflation. Don't get me wrong, guys. I'm just saying that the inflation rate goes from, let's just say 10% all the way down to 4 or 5.
Lower inflation.
Lower inflation, disinflation. That's correct. I can't find a time in U.S. history where, maybe there is one, maybe back in the 1800s or something like that, where you actually had a recession and didn't have disinflation. So the point is, right now, I know that CPI understates inflation, but let's just use that as a proxy. We're at 3%. If the Fed is cutting due to an economic contraction or recession, most likely, if history is a teacher, that means that the CPI is going to go down, not up. And in that case, what happens to gold? I don't know that it rips higher. I think it all depends on if we have a recession with a liquidity event. So if we have a liquidity event, then gold's probably going way lower.
I agree with that,
because it's doing its job, right? It's the asset with no counterparty risk that's always going to have a bid. So we go back to the cerveza sickness during that quick, like 2-week period in March when stuff was really hitting the fan. Gold tanks because that's the only thing that has a bid. So all these huge asset managers, they have to have some sort of liquidity. They have to have cash. So they sell the only thing on the balance sheet that they can, which is gold. Saw the exact same thing during the GFC, but that's usually your buying opportunity now.
And then coming out of that, it usually tears, right?
Yeah, that's right. And then if we have a recession, let's say, and somehow we avoid a liquidity event, then it's just, I think it's a crapshoot. Does gold go higher? Does it go lower? I don't know. It depends on what's happening with geopolitics, with the global central banks, with all of these other, variables out there.
Does anybody really know what time it is, George?
No, and that's especially now in 2025 when, my goodness, I think we said this on the last live stream where I don't, outside of March of 2020, I cannot remember a time where there were more unknowns. Just think about this. 2 or 3 weeks ago, everyone was talking about how the Trump tariffs were going to be inflation. And now all of a sudden, you're seeing the long end of the curve say, no, they're not going to create inflation. They might create disinflation. And I know that's very difficult for people to understand, but you have to realize that unless M2 money supply is going up, usually that means that incomes aren't going up that quickly. And therefore, if the prices go up at Walmart, that's going to take a higher percentage of your paycheck. And then you're going to have to take away that spending from somewhere else. So it is true that tariffs, let's just say, increase the price of stuff at Walmart, Home Depot, and Target, but they decrease the price of other things in that basket. And it's the same thing with oil. Everyone thinks that if oil goes to 120 or whatever, that's going to be wildly inflationary. Not really, because unless you have the money supply growth, again, you're robbing Peter to pay Paul. And often that high oil price is the trigger to the actual disinflationary recession.
Yes.
Let's do this. Let's go back and I want to see if I can find a time. What should I do here? I want to see if I can pull a chart.
I'll let you opine on the smart shit, George. Dude, you lost me like a minute and a half ago.
No,
I'm sitting here looking at my own reflection in the screen, like making funny faces at myself.
Just the deer in headlights, right?
Yeah, I can just hear in the background somewhere: inflation, disinflation, CPI, money markets. All right. Just let me know when it's time to step in and make a nice fart joke.
Come on, buddy. Come on. Now let's go over to, I think we have a Fred chart of this. Let's look at Fed funds and 10-year. And I know it's not updated because I checked it earlier today. Yeah, see, it's last updated, February 24th. So that's not up in real time. They're going to have to update that tomorrow, in which case you'll see this inverted once again. But let's max out here. Whoa, okay. Yeah, you see, we can go back to .com, and once it uninverted, it stays uninverted, and then it just really steepens out. And again, that's because of a what they call a bull steepener, or the short end is going down faster because the Fed's dropping rates so quickly. We had a slight uninversion right here in the GFC, and then it reinverted. But it wasn't to the degree to which we've seen recently. And then back in the 80s and 70s, it was just completely all over the place because the Fed, and again, most people don't realize this, but the Fed back in the 1970s and even with Volcker, they didn't really target an overnight rate. They targeted M2 money supply as much, much different. So it's harder to kind of look at the yield curve with the Fed funds back there. It's easier to do it with the 2-year and the 10-year. But yeah, this is just crazy stuff. Crazy.
The Fed's 2%. I'm sure that you know this already. I know that you know it, but I just heard it somewhere, and I'm less smart than you, and so I was mystified by this. But I knew that the Fed's 2% target was just kind of pulled out of thin air. That it came from the Bank of New Zealand, who used it as like a target at one point to for a completely different purpose.
Yeah,
and
but
then the Fed
they pulled that out of thin air. They're like, "What should it be?" They're like, I don't know. And
right.
The guy initially said 3%, and the government was like, "Yeah, a little too high. I don't know if we can sell that to the public." And he's like, "How about 2%?" Boom, let's go with it.
Just think about this. Whatever I was listening to, the person told me when or was talking about when the Fed started using the 2% target, which was just like, it was like 10 years ago or something, right? Or like 20 years ago. Hasn't been that long since the Fed has had this 2% target. Maybe Josh or somebody can look it up. Like, how long has the Fed used 2% as its inflation target? Oh, it was Peter Schiff. It was on one of his last days. So let's just call it 15 years or something, whatever it is, right? Like, when you think about that, okay, you think about how often that is brought up, right? They can't say anything without mentioning their 2% target. You would have thought that the 2% target was handed down from the gods in like 5,000 BC. Like, you would have thought that it was the bedrock on which all other economic and fiscal laws, bent around. Right. And just to hear Schiff talk about this and say, oh, it was, it's only 15 years old or 20 years old. You're just like, what the hell? Here you have the like entire compendium of like human thought on markets and, Keynesianism
it's like the theory of relativity in physics.
And it's just like, it's this little ass slice here where we've been obsessed with the 2% target, and you're going to try to tell me that we know what the fuck we're talking about? Like, if it wasn't obvious enough, and again, this is me, okay? I don't understand all that smart gobbledygook you just said, but like, I do know that if somebody asked Jerome Powell on a stage at a conference, what's the neutral rate? And the answer is, we just don't know. I know I can watch that, and I know that's an answer that this guy, based on everything he's said and I've heard, is supposed to have. That's the same thing with this 2% target. We've only been targeting 2% for 15 years. We tout it around as though it's the 10 commandments, handed down to us. It's just like, and then that means in another 10 years, or maybe tomorrow, there's going to be some other arbitrary bullshit thing that is going to be paraded around as the absolute objective truth. And we're going to play, diversion tactics to like look at that now. And that's why I'm so confident that like they're never going to get back to 2% anytime soon. And that 2% rule is just going to get scrapped if they can't get there. If they can get there, great. They'll say they planned it and they knew it all along. But if not, they're just going to invent something else. So it's fascinating to me that the 2% target, I knew it was bullshit to begin with. I knew we just took it from New Zealand, who was using it because of, whatever. But the fact that it's only been around 15 years is just, that's so alarming. And I think that should alarm everybody, because I'm not a PhD economist, but I can smell bullshit pretty well. I like to think.
So I think they can definitely get under 2%, but be careful what you wish for. Because if you're going under 2%,
yeah, when the NASDAQ goes to 1,
yeah, that means the economy ain't doing too well. It ain't doing too well. But that if you just use some common sense and think about a 2% or any target rate. So what you're saying is that if we're at 1% or 2.01, right, 1 basis point above, then, oh my gosh, we got to raise interest rates. We got to do QT. We got to do whatever it takes to get it down to 2%. But then if we're at 1.99, then you're telling me we got to do the exact opposite to get it straight. Oh, my gosh, we're in jeopardy of deflation. What are we going to do? We got to go ahead and QE and drop rates. And it's just for the 2 basis point spread. I mean, that's how insane it is.
Can you pull up a chart of CPI just over the last, 40 years or whatever? Can you find it? What I'm looking for?
Asking ye shall receive, my friend. Right?
Is a chart?
How far back do you want me to go? I can go to the 1800s.
No. This is good. Which one's CPI? The red one?
Yeah.
Yeah. Can you take out the M2 number, or you have to have both?
No, unfortunately, it's kind of annoying. I wish I could, but I can't.
Okay, so 2% is right about almost where you are.
Yeah, so 2%, this is 0% right here, Chris, where my pointer is.
Okay, yeah, I can barely see it.
Yeah, here, let me just, I'm way zoomed out here. Let me.
Okay, so 2% is the target.
I mean, 2% is just, right around, like right where my pointer is.
Okay, and we're like, we're at what, 3% and heading higher, it looks like?
We're at 3%. Yes, correct.
Look at that line. Just look at that line going back to like 2014 and think to yourself, like, that line has been everywhere but 2%. I mean, it's just,
yeah,
it's hilarious.
Yeah, it's hard to tell.
It's hilarious.
But right here, to your point, it was under, almost at 0%. And then remember, and look, I want to point out to people.
Yeah, if you could take, because the scale's fucked up, right? If you could take the M2 line out of there.
Here we go. Now it's easier to see right here. But notice right here in 2017 and 2016, you can barely tell the difference between where we were there and where we are today. But yet, for some reason back then, it was, oh my gosh, we're worried about deflation. We got to get it up to 2%. We got to get it up to 2%. Just the house is on fire. What are we going to do? And then now we're just slightly higher. And they're like, oh, we got to get it down. Or else we're going to have hyperinflation. And again, how granular do you get this, right? Again, if we're at 2.01%, are we still worried about inflation? And if we're at 1.99%, are we still worried about deflation? Like, where's the line in the sand? And if you actually think about that, that shows you just how ridiculous this is.
Well, it is. And if you could take the M2 line out, the scale would kind of adjust accordingly on this chart. And you would see that this line is a lot more volatile than it appears given the scale of this chart, which goes up to 30%, which is completely inappropriate for this line. But look,
another way to look at this, Chris, is let's just ask ourselves in the last, since let's just say the GFC, how often out of that, let's just say 15-year span, has the Fed been at their target? That would be 0%.
Right.
0% of the time. They've either been under or over. So
their mandate is price stability, right? Like, which is humorous, because even if they ride it out at 2%, that's still not stable prices. That's prices rising by 2% every year.
Yeah.
So how do you have a price stability mandate and then aim for 2% price increases every year? The whole thing is, you can just tell they're making it up as they go along.
Yeah, it is true, though, because let's think about the words they use. Price stability, yet their price stability is unstable prices. And then their other mandate is, what do they say, full employment?
Full employment, maximum employment and price stability.
Right, but full employment is 4% unemployment. So
right.
So it's both of their mandates. If you actually think about what they're saying in the terms they use, make absolutely no sense whatsoever.
Right. So full employment doesn't mean full employment.
Right.
It means 4% unemployment. And price stability doesn't mean price stability. It means prices rising by 2%. And that's where we are. That's the compendium of human knowledge as far as we've gotten. It's 2025. I wrote an article on my blog like a couple of weeks ago where I wrote like every meeting, every PhD economist, every single iota of human thought we have put into economics and finance over the last quadrillion years has led us to Fartcoin. That's what we've got. That's the best we could come up with after all this deep thinking. It's like maybe it's time to change something.
Yeah. You know what I was thinking today at lunch? I was just thinking to myself, wouldn't it be great if we went back to a time where people were focused on getting rich or making money from productivity as opposed to speculation?
Right.
Like at the end of the day, I think we've forgotten that. We've forgotten that the way you get rich and the benefit to society is if you're producing stuff. Goods and services. Well, it's not just getting rich on just pure unadulterated speculation, which would be Fartcoin.
Speculation is a hell of a drug because you're surrounded by people that are getting rich doing it. At least, I mean, you're not really, but all you're seeing are the success stories.
Or you're just looking at the chart up and you're ignoring when it's going down.
Right, which is the same reason they put bells and whistles on slot machines when somebody wins, because people walking by think, oh, I could win too, and speculation combines the ease of doing very little with the potential outcome of receiving the benefits of, generating a killer product or service or the things like you're talking about. So it's extremely seductive, and it's like a drug. I mean, it isn't going to end well, not for people personally, but it's not going to end well for the economy as a whole, because right now the market has kind of ballooned into this speculative monster where you have this entire asset class of crypto, which now represents $3 trillion of who knows what, anything from the next big burgeoning asset class that's going to change the world to complete air or somewhere in between. And you have retail access to any type of financial product or instrument you could want to basically bet on anything in the world.
With leverage.
With leverage, right, which is extremely seductive, because then you get a bunch of people sitting at home speculating on the price of toilet brushes in Indonesia, thinking that they're doing something when they're not. They're doing the same thing that I was doing when I was in the throes of a sports gambling addiction and betting on Korean ping pong at 3 a.m. I mean, it's just, I'm not generating anything other than stress for myself, I'm not generating anything. So Yeah, it is. And the market has a nasty way of reminding people.
Yeah.
It's just that now I think we've gotten further out over our skis than we've ever been. And it gives me great cause for concern, to be frank with you. The ability for, I saw today Vlad Tenev at Robinhood, who by the way is doing a great job. Vlad Tenev at Robinhood is thinking about using the platform to trade real estate, which actually is not a terrible idea. But this is coming in a long line of product and service expansions that he's added to Robinhood, one of which has been tying up with either Polymarket or Kalshi, one of these sites that basically allows you to bet on anything: political outcomes, election outcomes, whether or not the Epstein list will be released, whether or not Trump is going to pardon Ross Ulbricht. There's props essentially for everything in life now. They're not just prop bets for who's going to catch the first touchdown. Will LeBron James have 30 points? There's prop bets whether Jerome Powell is going to sit on the right side or the left side of the stage, or and so to have 50 levels of derivatives to every single thing that can possibly happen in the realm of human existence is extremely seductive and very dangerous, because it offers you unlimited risk on anything that you want 24 hours a day, which with leverage, like you said.
Well,
and
I
so
think it tells you a lot about what's happening with society. I mean,
yes,
I can't imagine that if we were to go back in the DeLorean to Roman times, when that empire was collapsing, I don't know that it would look a lot different. My guess, and I don't know this, but I'm not a historian, but my guess is that the amount of gambling, let's say, increased substantially back when that empire was
decadence
in its last days. Yeah.
Right. I mean, that's what it is. It's decadence. It's it's moving off the path from producing products or services, like you said, to just enjoying the spoils and the perceived luxuries of, being an American and having the dollar as a reserve currency, while at the same time kind of being willfully ignorant to the fact that I can't get on a subway car without stepping in human shit, which was the case like a couple of days ago in Philadelphia. And I was just talking to somebody else about this. It's like, how can we bring in all of the top line tax receipts that we bring in and not, how can I go to Montreal or go to Paris and get on the metro and have it be beautiful and it runs every 2 minutes and there's no homeless people and everything's clean and people are respectful? And I get on a subway in Philadelphia, and this was the case just a couple of days ago. I have to literally nudge out of the way 4 collapsed people. The smell is horrific, way worse than it used to be. And there's human fecal matter all over the place. And this was 4:00 on a Tuesday. I was going to catch the train or something. So, meanwhile, people have their heads down in their phones so much and they're too busy betting on, Fartcoin, derivatives of Fartcoin, options on Fartcoin, whatever the next, iteration of derivatives are. And, walking around as though life is great, but really when you stop. This is why Carl Jung said something like all of man's problems come from his inability to stop and sit and do nothing for 30 minutes. Because the second we all take a second and become present and look around us, we're going to realize man, this really isn't as great as we thought it was. And going out of the country helps a lot with that too. I found my trip last year to Europe was pretty eye-opening. And as soon as I came back, I was glad I was back, but I couldn't believe it. I couldn't believe.
You got to come down to Medellin, man. You got to come down to Colombia.
I should.
Yeah, the subway here is spotless.
I've heard I might be able to get a date in Colombia finally, which is not happening for me in the United States. So,
Chris, like I always say, there are no certainties. There are only probabilities.
I'll take anything I can get.
But even
probability
is very high.
I'll take a 4% probability. Okay, can you give me 4%? Because right now I'm at 0.
All right. On that bombshell, let's get over to consumer confidence, because we had the conference board come out today, and well, here we go, guys. Here's the headline. I'm not making this up, not George Gammon thumbnail. Pessimism about the future has returned. So the main thing that I want people to notice is the expectations index, because they have the present situation index, the consumer confidence index, all of which declined. But when you look at the expectations index specifically, I'll just read it right here. Based on consumer short-term outlook for income, business, and labor market conditions, it dropped by 9.3 points to 72.9. And this is the first time since June of 2024, the expectations index was below the threshold of 80 that usually signals a recession ahead. So, you can sit there and say, oh, George and Chris, you don't know what you're saying. You're too bearish. And like I said last time, and what I say on a lot of these videos, look, you've got a dam right here, and we're just pointing out cracks. It doesn't mean that the dam bursts. In fact, the dam, the water level could get higher and higher and higher. Who knows? But to not acknowledge the cracks in the dam and just bury your head in the sand like an ostrich, that is not a very good investment strategy. So it doesn't mean that the stock market's going to continue to go down or that we will have a recession, but we've got to pay attention to the data points in their totality. And this is just another data point that what's interesting too is the conference board, it was going up. It was becoming more and more optimistic once Trump got elected. And then we just see this complete collapse. And I think it could be that honeymoon phase is over. And a lot of people are looking at what Doge is doing and they're saying, hey, this is great. We're making the government more efficient and doing all these things. I love what Trump is doing with Ukraine or whatever he's doing with tariffs or Mexico, Canada. But then you're like, okay, now I'm still going out and trying to get a job and there's still nothing, or it's very hard to do. And I'm still having a harder and harder time putting food on the table and a roof over my head. I think that's possibly what we're seeing here in these consumer surveys. And I'd like to remind everyone that the Michigan survey came out last week and it plummeted by, I think it was around 12 percentage points, one of the biggest declines that we've seen in recent history. So it kind of back up what the conference board is saying here about the average Joe and Jane expectations for the rest of 2025. And it just goes to show you that the stock market isn't the economy. A lot of times there's an inverse relationship between the two, unfortunately.
Yeah, you're 100% right, which is why I can feel like an asshole writing on my blog for the last 2 years that, the economy is grinding to a halt, while in the other monitor window, I'm watching the S&P go to $1 trillion, and it's just, one is not the other. The stock market operates on a lag to the economy, if it operates based on the economy at all anymore, because the Fed has distorted things, like you said, so much so that, people don't even know which way is up. They don't know whether good news is bad news or bad news is good news. I take special exception to people that say that, what you talk about and what I talk about is stupid, because, not that I really care what anybody says, but the whole industry is replete with people that are only going to give you a positive spin, optimism, and bullishness. The entire industry, 90% of the industry is that. And it's not just bloggers and people that write newsletters. It's all the financial journalists. It's all the sell side research. It's all the investment analysts. It's everybody that's pitching a fund. And it's every corporation that's listed is giving you the rosiest outlook on their company and the foreseeable future. And companies will do that until the inevitable bankruptcy filing happens. And they will do it until the day before the bankruptcy. We're looking at strategic options to unlock value. It's like you have negative $1 trillion in equity on your balance sheet. Like, there is no value to unlock. Like, it's right there in the numbers.
Right.
So I took special exception years ago when one of these CNBC anchors wrote an article called "Perma Bears Are Ridiculous People." And it's just like, okay, like I get it, but you have to have two sides to a conversation if you want to be able to make any type of objective, best decision. And and you're right, the economy is not the stock market. The problem for people like us is that the economy is not the stock market. So for us to go on and talk about 90-day credit card delinquencies, like I was writing about the other day, and how those are starting to move back higher. Well, what does it mean? Well, it means that the American consumer is stretched. Well, what does that mean to the stock market? Right now, nothing. When will it mean something? Well, either never or at some point 2 years from now, something in the subprime lending world is going to break, or you're going to find out there was accounting fraud at one of these subprime lending companies, or some shit will happen that nobody can anticipate. And then everybody's going to go and look at that chart and be like, oh, it was right here. Look, delinquencies are out of control. It's like, motherfucker, we were just saying that like 2 years ago. We were trying to get people to look at it, but nobody wants to hear about it when the S&P does nothing but go up. And so I don't care if you want to be a bull or a bear. It makes no difference to me. I'm a libertarian. I want you to fly your flag, and I'll support whatever it's for. But, to be able to say that people shouldn't be allowed to have a skeptical voice, or that they're pissing into the wind by pointing this stuff out, that's extremely nefarious, because A, it's hubris, and B, it just is advocating for excess in one direction and euphoria to the nth degree in one direction. To just say, I mean, it's essentially like a call for censorship almost. It's essentially to say, like, only one outcome here is allowed.
Yeah, right.
And you're not allowed to say anything else. And that's what I mean. It's like a state planned economy, or a state planned, economic commentating, whatever you want to call it, which it's ridiculous.
And also too, Chris, people conflate a stock market being expensive with a prediction that the stock market is going to go down. So so as an example, I've been saying for 2 years, or I don't know how long, but the stock market is wildly overpriced. It's expensive. It's expensive. It's expensive. It's expensive. And people say, oh, well, look, George, you were wrong because the stock market went up. No. Just because the stock market went up didn't mean that it wasn't expensive. I mean, what are we talking about here? It's just like housing, right? You can sit there and say, well, housing has gone up over the last, let's just say 3 years. Okay, that's fine. But does that mean that we weren't in a bubble? Absolutely not. Because you can be in a bubble and the price still goes up, but that doesn't mean that you're not in a bubble. And just because the stock market goes from a CAPE ratio of 30 to 40, it doesn't mean that at 30 you aren't overpriced or you aren't expensive. So
it's like people that use technical indicators and say, like, oh, this stock's overbought or oversold. And I would say it could always be overbought or oversold like. It's not like the RSI goes to 75 and all life as we know it stops, and everybody opens an E-Trade account and sells one stock because of that. It's just, they're all lagging indicators.
Yeah, I mean, I'd like to point out, and I did a video the other day on how stocks can go a lot higher, and I just wanted to take the other side of the argument. And you can make a good argument for that, but you would have to come to the conclusion that, let's just say at the CAPE being at 38, that we could go up to like Japanese levels. And Japan, before they had their big bust, I believe they're right around 80, just comparing apples to apples. So could we go to 80? Well, absolutely we could. We for sure, the stock market could double from here. But again, it doesn't necessarily mean that it's cheap, and it doesn't necessarily mean that the risk reward actually makes sense.
Right. And that's why people say stocks take the stairs up and the elevator down. It's, that's why you get up, 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 up. And then one day you wake up and all of a sudden the market has diarrhea and everybody's looking at each other like, how come nobody saw this coming? It's exactly what we saw with COVID. One day you wake up and things are different. And to your point about, is the risk reward worth it? It's like if you had the Philadelphia Eagles playing a Division III college team, right? the chances are very, very likely that the Eagles are going to win that game outright. However, to bet on them, you would probably have to lay $1 million to win $100.
Yeah.
And then the question becomes, is that worth it? You know what I mean? Like, the bookmaker's job is to handicap the event so that essentially the risk reward remains 50-50 on each side, right? At some point, there would be odds that make it not worth it to bet on the Eagles to win that game outright, though they are very likely 99.999% of the chance, percent of the time going to win it. So, would you lay $1 million to win 100? Probably not. I know I wouldn't. Like, oh yeah, it's what? So I can sit there and sweat out the first quarter before the Eagles go up, 20 touchdowns, because there is a chance. It's like somebody told me early on in my investing career, there's never no risk, and that's the same type of principle. So, beware of anybody that tells you, hey, this is no risk investing. There's always a risk. It might be very, very, very small, but it's there.
Yeah.
There's always a catch.
And again, just because you made money doesn't necessarily mean that you did the right thing. And I know, and so like I always use the example of blackjack, Chris. So let's just assume that you've got a 19 and you hit and you get a 2. And so one person would say, well, that was the right decision. And then the other person would say, well, that's the wrong decision because the risk reward didn't make sense. And if you continue to make that decision, you're going to lose. You're going to go bust. So, what some person would say is, oh, well, look, the stock market went up over the last year. Therefore, if you were bullish, you were correct. Just like you hit on a 19 and you got a 2, therefore you were correct. Well, I don't know. Right. I mean, some people, and I'm not saying you're wrong or you have a bad opinion if you think that hitting on a 19 was correct. Just the way I look at things in my life, that even though you got the blackjack, that was still the incorrect decision because the risk reward didn't make sense.
Right. And you see that play out on blackjack tables all the time, especially when you have a novice player who sits down next to somebody who understands basic strategy and they get a 16 against a 10 and they look to the experienced player and they say that your inclination is you want to stand on 16 because you're pretty close and you feel like you're afraid you're going to bust. Anybody who's experienced playing blackjack knows that you want to hit a 16 against a 10 unless you have an option to surrender. And so they're going to look to that expert player and they're going to say, well, the book here says to hit, and they're going to hit and get 26, and they're going to look back at that expert and be like, how much could you really know if you just got it wrong this time?
Yeah.
Because they don't know. You're trying to win it 50.1% of the time and lose 49.9% of the time. You're not giving a guarantee.
Yeah, that's right. That's right. Okay, so bottom line here, guys, is the curve is inverting, which to me would tell me, I'm just kind of summarizing things before we get to Bitcoin, because that's going to be a big discussion here, is that the market is expecting growth in inflation to contract moving forward. And then we've got consumer confidence that's kind of layered on top of this, that's kind of confirming what we're seeing in the treasury market. And then we've got Bitcoin that's confirming, I think, all those two things in the sense that it's risk off. Now, I think Bitcoin's great. I think everyone should own it, have purchasing power outside of the system. But if we're just going to look at the price action, it has been kind of tied at the hip with risk assets like the NASDAQ. So when we have a risk off environment, which I think we have at least for the last few days, and the curve is an example of that, then you're seeing that Bitcoin's soft, and it's not just selling off, it's selling off massively. I mean, I think today we're at 85, 86, something like that. And then you look at the share price of MicroStrategy, or Strategy, as Saylor is now calling it, and they are down at the 250 range. And so I'm not saying that they're in jeopardy of going bust, but it is kind of an interesting thought experiment. I know, and Chris, this is really your cup of tea right here in analyzing balance sheets for these corporations that, let's just say, get overextended. And so I know they've got about, as the price today, have about 40 billion of Bitcoin on their balance sheet, which obviously their biggest asset. And then on the liability side, they've got about 8.2 billion worth of debt. So, you Bitcoin would really have to come down in order for them to be in a position to where they might be insolvent. But I'd like to also remind people that just a couple years ago, Bitcoin was at what, 15, 16,000. And I'm not saying it's going down to that level, but if it did, then MicroStrategy could be very close to insolvent. And I know they don't have to pay their convertible bondholders until 2028. And I get that argument. So it could go down to $1 and they still might not have to pay them. But if Bitcoin goes down to $1, I can assure you MicroStrategy will likely be filing for bankruptcy. But again, this is your specialty, so I'll let you riff on this one.
Nothing's my specialty. Let's just disclaim that. No, but seriously, I think that what I've been writing is that, crypto is kind of the tip of the spear as it comes to risk. And so what I told my people in my little blog chat room that I have today is that I wasn't surprised to see the market off today after watching Bitcoin come off last night. Regardless of what Bitcoin is or isn't going to do, it seems to be the leading indicator for speculation.
Yeah.
And so because you have, in essence, if you look at like a funnel of things that you're going to sell in order to deleverage, it would probably be first on the list. Like, you're going to sell your Bitcoin or your crypto. Let's say your shit coins first. You're going to sell your shit coins before you're going to sell your Bitcoin. You're going to sell your Bitcoin before you're going to sell your stocks. You're going to sell your stocks probably before you're going to sell your bonds. You're going to sell your bonds probably before you sell your car, and you're going to sell your car before you sell your house. And then, then you're completely illiquid, insolvent at that point. So at the very, very top of the risk-taking spear is crypto. And so it's going to be interesting to watch here, because I think it's going to act as a good canary in the coal mine for when the rest of the markets and economy in general are getting ready to kind of puke, which is what we've seen here over the last week or two. There's a bunch of other questions, obviously, one of which is, what does the Bitcoin market look like? Where is the liquidity coming from? Where, what's going on with Tether? What's going on with the other stable coins? Everything was fine at FTX until we woke up one morning and it wasn't. I remember that day. I woke up and started reading CZ's posts on X, and, I was just thinking to myself, here's something that nobody saw coming today. You got the head of Binance calling out the head of FTX for using customer funds or whatever was going on. And the thing was bankrupt in a week. They had a bankruptcy filing in. And so we don't really know what that whole crypto market looks like or what's going on under the surface there. And we won't know until the shit starts hitting the fan and the leverage starts coming off, like you're talking about earlier. So for me, the way that I'm watching it kind of is as indicia of what the rest of the market is eventually going to do, because I think crypto will break first before tech stocks. It'll probably go crypto and then tech stocks, or they'll move down in tandem, but crypto will move off 8% like we saw last night versus 2% for the NASDAQ today. Having said that, the jury's still out as to whether or not it's the next new incredible digital asset class that's going to act as sound money, or whether or not it's a whole lot of nothing over the last 15 years. And we're just drumming up a bunch of nonsense because we have more liquidity and time than we know what to do with. As far as micros,
I want to be clear for the viewers, though. What we're focusing on right here, guys, is not whether or not you should own Bitcoin, or whether or not it's going to be the next global reserve currency, or people are going to use it as a medium exchange. I'm just shelving that argument. I'm just trying to focus exclusively on the price action recently, and then what's likely to be the price action in the next couple of weeks, short term, midterm, and then how, if at all, that impacts MicroStrategy. So sorry, Chris, go ahead.
Let's just say that there's no manipulation in the Bitcoin market, right? Let's just give it a clean bill of health and say that every buy and sell has been completely legitimate, and there's been no wash trading, and there's been no manipulation of the stable coins, which obviously I don't think is the case. But let's just say that. the way that the bull case goes is that as long as you're consistently buying the top, that every uh, correction or every 5-10% pullback is an opportunity, because as we print more money, there's going to, and the dollar loses its purchasing power, Bitcoin, which has a fixed supply, is going to continue to rise in price. And that, it makes sense. It's kind of the argument about any fixed supply asset. If that's the case, even with a non-manipulated underbelly of a market, what that means is, and we know people are buying on leverage, right? So we'll assume that. And what that means is there will be a point where it moves lower sharp enough that it's going to cascade into a much lower move that is going to cascade into a much, much lower move. And this last 24 hours is not it. You'll know it when you see it. We'll be down 50% in 2 days or something like that. There will be a reckoning, because even if you're bullish on Bitcoin for the long term, people say the volatility is part and parcel with owning it. And the way that the argument of consistently buying the top because there's a fixed supply goes, in essence, the world's longest chain letter type argument, it means that even if it does survive for the long term, we are going to see serious drawdowns. If you go back and look at a chart, I think the drawdowns have been like 70%, 80% from highs at various points. Now, the lows get higher and the highs get higher. So an 80% drawdown now would probably bring us to the top of the last super cycle. But it will happen. It's a mathematical certainty, if you want my opinion. And of course, this is not financial advice. But then if you start peppering other things into the mix, like potential manipulation in the market, and we just don't know, man. It's a big black box. The only thing I can say with some certainty is it's the tip of the speculation spear, and will kind of act as that canary in the coal mine.
Yeah, here's a chart. Bitcoin back up to 88. I mean, just the intraday moves. I mean, just talk about volatility. I think something that most people miss is,
like, you have a guy commenting here, it already did it yesterday, liquidation cascade. It's like, yes, but like that's not what I'm talking about. Like, it will make yesterday look like a picnic at the park. Like, you don't take on 100 to 1, 50 to 1 leverage, the kind of leverage that's being taken on in the Bitcoin market, even with somebody like MicroStrategy cornering the market essentially, or Larry Fink and all the ETF buyers cornering the market. Retail doesn't take on that type of leverage and speculate without seeing a much, much, much sharper move lower.
Yeah, because let's think about this, guys. The retail investor isn't selling convertible bonds. They're maxing out their credit card. So that's a whole different ballgame than what Saylor is doing, as an example. And I also want to point out, from a mechanical standpoint, what most people fail to realize is, as the float or the outstanding supply that's for sale or could be sold gets lower and smaller and smaller and smaller, this actually has the tendency to increase volatility to the upside and the downside. So what is Saylor doing? He's buying all this Bitcoin and he's hodling. Okay, well, what that's doing, the more people that hodl, the lower the float is out there that can be sold. So then what ends up happening is you have this, we see it in real estate too. You have, let's just say, extremely low supply, but then you get let's say 1 month, 2 month, 3 months where the price really doesn't go up. It just kind of chops around. Well, if you have historically low supply in an asset and the price isn't going up, what does that tell you about demand? That by definition,
exhausted.
Demand is just as low as supply. So if supply is at an all-time low because of all the hodling and Michael Saylor taking the Bitcoin offline and whatnot, and the price isn't mooning, it's just chopping and going up and down, that tells you that demand for buying more Bitcoin is at an all-time low as well. So that what that means is, if you get just a little bit of selling, that you can hit these air pockets in the price, and you increase the vol on the downside, but you also increase the vol on the upside. So it's not that it's bearish or bullish for Bitcoin. It's just mechanically, usually that's what happens when, let's just say, more and more people hodl a specific asset.
Right. And it is possible to get to a point where a question needs to be asked of who does MicroStrategy sell to? Like, let's just say they get jammed up, like who, and, they're using their Bitcoin as collateral. So it's like, well, where's the bid? If the market collapses, where's the bid? Who's the buyer?
Yeah, I don't think, and I don't know how this balance sheet stuff for the financial engineering really works, but from what I understand, I don't think he's in trouble, at least, before these convertible bonds mature or they hit I forgot what it's called, the expiration date or whatever it is. And then these convertible bondholders have a choice. They can either get paid in more shares, and then they do that if the price was higher than the initial agreed upon price because they'd pocket the spread, or they get paid in cash. So the other, and that's what most people just exclusively focus on. But I think what they're missing is the possibility, and I think it's probably a low probability, but the possibility of Saylor having 8.2 billion in debt right now, and this assumes he doesn't take on any more debt. And Saylor being Saylor, I don't know why he wouldn't, but let's just assume that he keeps it right around 8 billion. If the price or the asset side of his balance sheet goes down to, let's say, 6 billion, now all of a sudden he's in bankruptcy mode. And I'd have to read the fine print of, how this contract was structured. But Chris, correct me if I'm wrong, if they're in bankruptcy, even if Saylor doesn't want to sell the Bitcoin, the bondholders take over the assets of the entity, and the bondholders decide whether or not they're going to sell Bitcoin. And the bondholders likely would sell to try to recuperate any of the money that they lent him to begin with.
I don't know if that's how it works in Strategy's case, because I haven't looked at their debt covenants or looked at their bonds very closely, but there's something similar to that is usually what happens. If they get into bankruptcy, I mean, that's a completely, it's game over at that point anyway, so it doesn't matter. But they're very far from that, and the stock does still trade at a premium to its NAV. And he is being afforded the ability by the market to take on debt at 0%. And so, it would almost be foolish for him not to do that. So again, it's not a likely scenario, I don't think, but it's like we're talking before, it's a scenario that needs to be considered and at least talked about. Especially,
that's not my prediction. I'm just kind of going through the mechanics. So people, because I see that most people on Twitter get fixated on, the expiration date for the convertible bonds and what happens then. And I think that's an important discussion. But I also think you've got to consider the very low probability that he does have negative equity. And, I don't know how that works. I don't know if once he gets negative to a certain point, all of a sudden that immediately triggers like a chapter 11 or something like that.
Yeah, I don't know the mechanics other than the price gets low enough at some point to fuck up the works. And that's just like using any collateral for any type of loan. When your underlying collateral shrinks, whether you're borrowing against stock that you own or whatever, then the lenders are going to have to figure out exactly how to slice and dice you to get back what they.
Yeah, and also let's remember that if the share price for MicroStrategy is under, let's just say, the strike price that they agreed on, then obviously that bondholder is going to want the cash, and MicroStrategy likely doesn't have the cash. So that would also force them to sell the Bitcoin to come up with the cash to pay the bondholder, whether Michael Saylor likes it or not. So that's another dynamic to consider.
But his maturities are way out. I mean, he's a long way from that. So
That's right. So again, these are very low probability stuff. I'm not sitting here saying that MicroStrategy is going to be bust tomorrow and Michael Saylor is going to have to get a job at McDonald's or whatever like that.
It's fascinating to watch, though. I mean, the Chinese say, may you live in interesting times. I mean, here we are bearing witness to what is being pushed as a brand new asset class, which it is a new asset class. It's an asset class. I mean, BlackRock's buying it. It's something. Um, and look, like I have exposure to Bitcoin too. And so like, uh, because I'm uncertain as to what its future is going to be. And, I have a modicum of exposure, not a ton, but enough so that it keeps me interested in watching the story as it plays out, because it really does feel like one of those things where, I mean, it's going to be a chapter in like the history of humankind book at some point. The only question is like, which direction is it going to go? Like,
Yeah.
is it going to be the advent of the next internet, or is it going to be like one of the biggest bubbles ever blown? And I don't know. To me, it's interesting just to be able to sit around and chew the fat about it and talk about it and observe it on a daily basis. Look at the players involved. I've Peter Schiff is a friend of mine. I had the luxury of interviewing Michael Saylor for my blog, 6 months ago or whatever. And I asked Saylor, I was like, can I get you and Schiff together on a debate? And he didn't want to do it. So to me, it's very fascinating to have these two sides of dialogue about it and just kind of watch where the cards continue to fall. I mean, it's interesting times for sure, man.
Yeah. The thing that I kind of makes me nervous, Chris, is whenever I see a company like change their name, and whenever I see a company come up with new accounting methods, like a Bitcoin yield, that always kind of rubs me the wrong way.
That's what Alex Mashinsky from Celsius was saying during his, Alex Mashinsky from Celsius did a debate with Peter Schiff. And one of the things that he kept proclaiming on the debate was Bitcoin pays a yield. And Peter Schiff's like, Bitcoin by itself does not pay a yield. You have to be generating that yield somehow. You have to be taking risk in order to produce the yield, which is pretty econ 101, like when it comes down to it. And Mashinsky kind of ducked and dodged the question, and lo and behold, he was bankrupt 6 months later in that one drawdown, and now he's facing jail time because he took the money and he was pissing it away and fucking around with it. And so, I agree with you. Look, and working on the short side of equity markets for a long time and identifying companies that are problematic for a decade, I did it. You see a lot of shuffling around the deck chairs,
isn't it? When they start doing weird accounting stuff.
What you like to see is a company with a niche in a market that's generating cash consistently and growing its top and bottom line. That's what you like to see. I don't give a fuck what you name it. I don't give a fuck what industry it's in. I don't care if it's in the frozen yogurt industry. I don't care if they make, little rubber ball bearings for one certain type of dental instrument that they only use in Mexico. I don't really care. If the top line is growing, the bottom line is growing, they are established, they have a niche in a market, and they're generating consistent cash and returning some of that to shareholders, everything makes sense. I don't care what you call the company. You could call it, you can call it anything you want, man. Like People Pops and Fuck Sticks at the Shit Factory. Like, doesn't matter, right? Generating cash, understandable business, has a moat, growing top and bottom line. Everything else that falls outside of those boxes, different accounting methods, changing of names, bringing on board members who are celebrities. Right. You see all these things. Any company that's got a black box that they can't explain, some related party that they're doing business with, but you don't have access to their financials, or they won't tell you the customer concentration, or there's some segment that just says other and nobody knows what that is, but that makes up 71% of net income. Like you're saying, name changing, all these things. That's all just, none of that is really any value add. It's just putting out press releases with nothing in it. You want to put out a press release that I like? Here's one. It says net income up 10% since last year. Free cash flow up 10% from last year. Top line up 20% from last year. Margins expanding. And we've got a new customer named XYZ Corporation based in X-Town, USA, that everybody knows. And we've got a new partnership. And that's digestible. That's tangible traction in a company. Or we've innovated. We've got a new product and we've already got a backlog, Anything else is just rearranging chairs. It's like, look, I'm bald, right? I can put on any kind of hat, and it's not going to change the fact that I'm bald. You know, it's like Tim Pool. Just take the hat off, man. You're bald. I happen to be wearing a hat because I'm freezing today. I don't care that I'm bald. You know, I could put any number of things on my head. I could put a winter hat on. I could put a baseball hat on. I could put some 18th century headdress from, you know, Costa Rica on my head and walk around like the guy from Jamiroquai. Nothing's going to change the fact that I'm bald. And so at the end of the day, it boils down to, what is your business? You know, where is the yield and the cash flow coming from? Is it understandable? Peter Lynch would say, you know, a business that you can illustrate with a crayon, right? Is it simple? What do? I make hot dogs. Great. Who's your competition? Nathan's, Hebrew National, Procter & Gamble, whatever. What's your total addressable market? $200 million worth of hot dog eaters in the eastern seaboard of the United States. You know, simple, easy to understand. Anything else is just noise.
Yeah, but what I want to point out, Chris, is you could be wearing a hat to hide the fact you're bald. I'm not. My head's cold. No, but you see what I'm saying there, right? I mean, I'm not saying that MicroStrategy is going out of business, but it just is eerily similar. It reminds me of a story I did yesterday. I'm trying to pull it up on, I think I deleted it, but Joanne, et cetera, just went bankrupt yesterday. They're closing all
the craft store.
Yeah, they're closing all 800 stores. And I didn't even realize it until I did the story. But I guess they changed their name from Joanne, et cetera, to Joanne. You know, just trying to and again, that to me, that's kind of, you know, wearing a hat to hide the fact that you're bald. And
right.
I'm not saying MicroStrategy is doing the same thing, but they're definitely, you know, changing the name and doing the Bitcoin yield as a publicity stunt. For what reason, I don't know.
Why do you wear a hat? You have a great head of hair. You know, I'm kind of annoyed with you. And while we have 2 bones to pick here, one is that you got a great head of hair and you're wearing a hat. That's like an insult to me, number one. And number 2, one thing I was going to talk to you about earlier is, can we please talk about the thumbnails on your posts? And here, I'm just going to say one thing. I'm never going to bring it up again. All right.
Yeah.
I was scrolling through them earlier. All right. You're making the same face in every thumbnail, right? There's like, as if like you just discovered plutonium by accident or something, you know, like
I did.
Dude, let me just tell you something. Not every day is worth, you know, I know that you have to sell the sizzle, right? But then when people come on and they have to listen to me try to, you know, pretend like I understand what a balance sheet is, like they're going to be very disappointed when the world's not ending and the asteroid hasn't hit. So I want 1 thumbnail a week of you just demure and like this. That's what I'm requesting.
Okay, so first and foremost, the hat, I put that on just because I don't have time. In the morning, I'm doing so much stuff, doing so many thumbnails, creating so much content that a lot of times I just don't have time. So it's easier, and it's a branding thing with End the Fed. Everyone kind of knows it. When they turn on a video, they know it's going to be a George Gammon video if I'm wearing a gray hat that says End the Fed, or we got one back here as well. As far as the thumbnails and the titles, what you have to do there is you have to create curiosity. Now, a lot of people confuse that with clickbait, and then it's not the same thing. And a lot of people say, oh, doom and gloom. And not all the titles and thumbnails are like that. But what we try to achieve with those thumbnails and titles is trying to create some sort of curiosity. And when you know
I'm not saying doom and gloom.
Yeah, but when you know you've crossed the line, Chris, it's actually pretty simple. Because on the back end, you can see the percentage of thumbs up to thumbs down. And if you truly do have clickbait where you're promising one thing and you deliver something completely different, you're going to have a lot of thumbs down on that. And that the algorithm isn't going to respond to that. And your audience isn't going to respond, rightfully so, because they click on a video and they expect to see something. So you've got to, if anything, under promise and over deliver. That's how you grow a YouTube channel. That's how you get a lot of views. Now, why do we use the same face on every single one? Honestly, I just have.
That's an over promise. No, the like shock and awe face is an over promise.
No, because you're first of all, people respond to human emotion, and that's going to increase the curiosity. But honestly, the reason why we're using the same one is because I just haven't had time to take more pictures. So Josh literally just has like 2 shots, and he's got to
choose Josh
A and B.
I want Josh
that's the honest truth.
Use one one very sad looking thumbnail for one of them, and we'll see how it performs.
No, we've done that, and it all depends on the title. So let's just go to the back end analytics.
This guy said you should wear a do-rag on the next podcast. I agree with that.
But let's go to some of the older videos here, Chris. Check this out.
Celebrating the cultures of the world. George Gammon.
So like right here. So see this one?
Yeah, let's see.
Can you see that thumbnail? I can't really.
Yeah, that one looks better. All right,
Yeah.
I like that one. I haven't seen that one.
So, or this one right here. So you see, it's just stone
Trump
cold.
wins, and then you just look like nothing happened.
Yeah, but see that we probably didn't have time to do a thumbnail. But other times, you know, if you use this,
that's one where you should have a huge. You know, Trump wins. That happens every 4 years, the election. So you should be like,
I know,
you know, and then it's like today's is like, oh, consumer confidence on some survey nobody's ever heard of came in 0.001 points lower than it's supposed to, and you're like,
yeah. So, but again, a lot of times, just me being honest, it boils down to the fact we just don't have time. But look at this one. So this is a good example of using that non-emotion face, but where it actually works really well with the title to generate curiosity. So you've got that look, but then it says new GDP numbers reveal why you have to vote for Kamala Harris. You see how that with that face, and
I would have a sad face too.
My position that's gonna create that curiosity. And people are going to click on that. So it's all just this. It's actually kind of, there's some science to it, but that's also an art form where you're combining those two things to try to, you know, encourage people to click on the video, because at the end of the day, how good your content is doesn't really matter if people don't click on the video.
I know. I just wanted to break your balls. I don't really care. That's it. Josh said he'll rock the do-rag next time, which would be great. So that I'll look forward to.
Yeah. All right, Chris, how can people find out more about what you do? Tell us about the Substack.
I have a Substack. It's called QTR's Fringe Finance.
What? And
that's it.
You go to
quotetheraven.substack.com. Yep.
Okay, cool. Well, on that bombshell, guys, enjoy the rest of your afternoon. Hopefully you enjoyed the behind the scenes deep dive to the YouTube channel. Make sure that you are standing up for freedom, liberty, free market capitalism. We'll see you in the next video.